All right. Hey traders, Akil Stokes here of Trading Powered and welcome to the weekend review. I don't have anything really planned for this week, so I'm going to go off the top of the head sort of. I know I want to talk about the European news that came out this morning and how to go about trading that. And I want to talk about a recap of the Euro-Aussie trade. So we're going to start with the day that was today in our day trading. If you're an intraday trader, well, you're aware that the Euro, the ECB decided to not change interest rates, and there was also a handful of news coming out this morning. There was the ECB press conference, there was U.S. trade balance, there was the unemployment claims report in advance of tomorrow's non-farm payrolls, and well, just a lot was going on around the opening of the markets. And well, if you were anywhere on the lower time frames, and I guess even the higher time frames, you saw something like this. Let me delete this. This is a euro yen chart. We saw this on the euro dollar as well. But looking at a euro yen chart right now, you can see within a matter of really between 8:35 and really 8:35 and about 10:15, we saw a straight shot up from 136.87 to about 138.68. So almost a 200 pip move on some of these euro pairs this morning. Now, if you're looking at a 5-minute chart, you're probably saying to yourself, well, Kill, there's no way I really could have traded this unless assuming you didn't catch it at the bottom somehow, or you didn't get emotional and just saw a whole bunch of green candles and said, guess what, I got to get aboard, which probably would have been a wrong decision, and more times than less you're going to get burnt doing that. And here is why the range bars come in handy. And I like using the range bars in my day trading, and people don't understand that the range bars just aren't for day trading. I use the 5 minutes to kind of simulate the lower time frames, but you can also go to a 13 or an 8 range bar chart, which is going to be more like a 15-minute chart, a 13 range bar chart where you're getting to maybe the hourlies, a 21 range bar chart, all the way up as much as you want. I personally like to stick to Fibonacci numbers, but you can use these range bar charts on a higher time frame as well. But again, look at this right here. We saw a big boost up, 1, 2, 3, 4, 5, 6, 7, about 2 hours of straight green candles, little red ones mixed in there. But really an untradeable scenario. However, if we go down to the range bar charts, I'm looking at, where's my euro yen? Euro yen right here. During the same time, here's what we saw. We saw an initial boost up here. And here's how you can involve yourself in one of these trades if you're trading the reaction to these news events. I'm not saying go out and trade all the news like this. Don't go out for non-farm payrolls tomorrow and try to do this. But if you're a trend continuation trader and you're looking to jump on these moves, here's how you go about doing it. What we do is we wait for this break and close of structure. Again, a break and close of structure right here, this red line I have drawn in. This is going to signify to me that a higher high, higher close, that we should see a continuation in that direction for the overall market. After we see that, what I'm going to do is look for a retracement back into previous structure levels. And really, we have about 3 levels right here. If you see my red lines, one, our highest one, which is really tops of structure. We have an intermediate structure level, and we have a lower structure level as well. And what you want to do at that point is, as soon as you have that bias that you believe the market is going higher and you're looking for a retracement and a chance to hop on, then you just need to use one of your various trading techniques to get involved. And there's tons of them that we go through, tons of them that we teach, too many to talk about in this review. But a simple one right here is actual just a simple ABCD pattern. We take an equal measure move, this swing high to this swing low, our A to B leg. We get a B to C retracement in here. We get a C to D move, boom, right down there. Beautiful ABCD pattern completion. If we use a Fibonacci retracement tool as well, we can get some confluence. Take a Fibonacci retracement from our swing low down here, the beginning of our impulse move, to our swing high. You can see a 382 Fibonacci retracement is going to be right underneath there. It doesn't exactly hit it. We come a little short. That's one of the reasons I didn't get involved in this trade. Also, I have a lot of filters when it comes to my trend continuation trade. I'm really big on risk reward. So if there's no structure level to hide stops underneath, and you can see with a straight shot up, I have really no place to put stops aside from under here. In scenarios like that, I'm really cautious about entering these trades, and well, today I just didn't get triggered on what I would need to enter. With that being said, we had a few live room members that caught this move and well had a pretty good day off of it. But you can see a simple harmonic move back into structure, back into a Fibonacci retracement, and then boom, the rest is Well, the rest is history. You see we extend it back up. And like I said, there's tons of ways to do this. If you're a CTS trader, combined technical score trader, there's a whole checklist of things and technical indicators that you can look for. Um, but again, with anything else, you don't just go out and trade this. Go back, find a strategy that works in your favor. Find something that has a statistically proven edge over the market. Back test it to make sure that's true and has a positive expectancy, and then you can involve yourself in moves like this as well. Now, speaking of risk reward, now that we're on that topic, I did show the traders a good example of a very good risk reward scenario. This would have been one that wouldn't be to my liking. Again, if I entered right here, I'd have to have stops at least below here, which means my targets would be, let's see, to get the 1-to-1 would be right up here. And that's going to be a little bit higher than a 1-to-1. Let's see where my targets would have been at. Yeah, you can see that's going to be a little higher than a 1-to-1 risk reward. And I don't want to involve myself in situations where I'm willing to give up more than what I'm willing to gain. But there was a recent trade which showed a perfect example of a scenario that I do like. And this was a trade I talked about a few weeks ago on Aussie CAD. It was a 4-hour trade, and we took some time in the live room today to kind of discuss the importance of risk reward and how putting yourself in those positions over and over again can benefit your trading. Now, Aussie CAD, simple trade right here, structure-based trade. Market came down. We retested previous structure looking left over here. You can see the market double bottom down here. I had some divergence on the RSI. Also had some divergence on the MACD, which are two things in my trading plan that I was looking for. That gives me the thumbs up that say, hey, Akil, this is a good level to take it. And you can see the rest is history. But here's what's important. It's not that the market moved up there. It's the risk reward that was given on this trade. And my entry was right about here at this red line. See, my double bottom was right here. Right about here at this red line. And I was only willing to risk this much on this trade. Stops are right where this blue mark is at. Right above that 95.50 handle. I think I had it at 95.72, something like that. But the fact is, I'm only willing to risk this much for this trade while I'm shooting for targets that were all the way up, back up at a retest of our previous structure highs right here. So you can see when I line these boxes up, I mean, check out this risk reward. Boom. It's almost a 3-to-1, I bet. Let's see. 1, 2, 2.5-to-1 risk reward. And why this is important is because, again, not only if you consistently put yourself in this position to win more when you win than lose, when a trade fails, you're going to have a greater chance of being profitable if you're, even a little bit less than a 50% trader, probably even a 40% trader. But psychologically, it does wonders because, well, you know that, hey, if I'm a trader that's consistently putting myself in this position, I know I only need to win maybe 1 out of every 3 trades, 1 out of every 2.5 trades. Think about how much pressure that relieves from you. One of the hardest things about trading is thinking that, hey, I have to beat the market every day. I have to win this trade. That's a lot of pressure. And when it comes to it, that's what causes people to hesitate on pulling the trigger for entries. It causes people to roll stops up because they're scared. It causes people to take targets early. All those little fears and demons and emotions that come out are caused because you feel this need that you have to be right a certain amount of the time. So imagine if you can put yourself in a position where you know that you could be wrong more than you're right and still make money. How much pressure will that relieve? How much easier will it make it for you to enter trades when you're supposed to keep targets where they're at, to not move stops too early? I mean, trading is probably one of the 3 careers where we could be wrong more than we're right and still be profitable. Look at a weatherman. Weathermen make a good living being wrong more than half of the time. Look at a baseball player. If you're a baseball player with a 300 batting average, that means you're getting a hit 3 out of every 10 times. You're one of the best in the league. How crazy is that? Trading is the same way. If you put yourself in the right scenario, you could be right 1 out of every 3 trades, 2 out of every 5 trades, and still be very, very profitable. So risk reward is great for the account, obviously, but more so for the psyche and the mentality and allowing you to stick to your plan and really see these trades out. We're on the higher time frame. Let's talk about Euro Aussie. I told you I didn't really have a game plan for this video, so I'm kind of just rolling through whatever's on my mind. Euro Aussie, I got to be honest with you guys. I made a mistake on this trade. I hope you're not disappointed in me, but I'm going to be honest with you because, well, that's how I've been for this long. This is why you guys like me. But last week we talked about Euro Aussie, and if you didn't see the video last week, go ahead and check it out. We did a great top-down analysis from the daily chart down on, hey, why you should buy Euro Aussie at 53.04, why I think that's where the next bounce is going to be. Came down, and you can see on the lower time frames, the 4-hour chart here, we had a bat pattern. And well, the market came down, nailed our bat right on the nose. Market came down right to 53.04, 53.02, and what do? And I got a lot of tweets and messages about this on, I think Monday it was. The market immediately shot right back up from 53 even all the way to about, what is this up here? All the way to about 54.81. So we shot straight up 184 ticks right off that level we identified. The problem is, me personally, my targets were right below this even handle. My targets were at about 54, I think 95 or 98. So we were about 15 ticks short of me banking out for profit. You can see we didn't get there. Now that's not the mistake I made. My targets were in the right place. I live and die by my targets. I'm not going to take profit early, even seeing up 180 ticks. I've made that mistake enough times to know, hey, Akil, just wait it out, trust your targets. The problem that I did was, well, this was Monday. We had a lot of snow. I was snowed in. I took a lot of time shoveling and said, you know what? The wife is home. I don't spend as much time with her as I need to. I'm going to catch a movie with the wife at night. Went into the living room and watched something. And what I did was I neglected to do my evening analysis. And during my evening analysis is when I look for news events, when I do my top-down analysis once again, basically see what happened during the day. And there was an Aussie news event, an Australian news event that came out that night. And that's what caused this big, humongous candle down. And I don't let news events affect most of my trading. But when Aussie news comes out and when New Zealand news comes out, those are events that I really pay attention to just because of the time of day when they happen. There's not a lot of liquidity in the market when those news announcements are released, and, well, Aussie's walking on eggshells right now anyway. So usually when those events come out, especially if they're major news events, they move the market. So I have a rule in my plan that says if that Aussie news is coming out or New Zealand news is coming out, I get my stops to break even. I wait to see the reaction of the news, then either usually I'm stopped out or targets are hit, depending on which way the candle goes. But say nothing happens at all, I move my stops back down to where they're at. I didn't do that because I skipped out. I played hooky on my evening analysis, and because of that, instead of being in a break-even trade, instead of being stopped out as this market rallied back down, I took the full loss down here of 130 pips. So that's a mistake that I made. Again, I want to be honest with you guys. It's not just you. It happens to the best of us. But you know, what do? I recognize that mistake. I write it down, and I try my best not to let it happen again. So that was Euro Aussie for me. Unfortunately, I didn't get the profit off it. I know some of you probably did. Some of you may have had stops at the B leg instead of the 382, which means you would have just hit targets. But that's the way the cookie crumbles sometimes. So that's it for this week, guys. I do want to, well, I was going to talk about a little bit about the true value of a pip. Maybe I'll save that for another lesson. I'll save that for one of my write-ups on the blog or the Trading Powered site. And by the way, if you guys are just watching this on YouTube, go over to my blog, www.ratiotradingmentor.com. I write there at least about 2 or 3 times a week, just thoughts of a trader, stuff that's on my mind during the day. So I'll probably do a blog post about the true value of a pip over there, as well as maybe the Trading Powered website as well. But definitely subscribe to that blog. It's free, and it's people like it. That's why I'm doing it. But until next time, guys, plan your trade your plan. Good luck in the markets tomorrow. Watch out for that non-farms payroll, and I'll see you guys later in the week.